The Hide It Company, a family-owned business located in Tombstone, Arizona, builds custom homes with a special type of feature, such as hidden rooms, walls, safes, etc. They have been an audit client of the same company for the last 3 years. The Hide It Company was to be signed off on a clear audit, and when an issue arose from a bank account that the company had prior to the management they have now, this account had money that was deposited, interest earned, a withdrawal, and a balance of $450,000 that has not been on the Hide It Company's financial statement ever. The managers of Hide It Company did say that they were aware of this account and they did not include it, but Art did assure the auditor that the funds were legitimate. The funds had come from separately billed but unrecorded change order items and contracts completed before you became the auditor and before Art or any of the members of current management became involved with the company. After looking through the account, there is insufficient evidence to reconstruct the nature of the cash transactions that the Arizona Department of Revenue came up with. The manager, Art, did inform the auditor that they were willing to pay a combined tax and a penalty of 12% on the total funds within a 120-day period. Art also states that negotiations for those are already in process with the IRS. In this analysis from the auditor, will determine what the auditor should do if this is an error or fraud, or why not the auditor should resign as the auditor. First, let's take a look at what an error and fraud actually is distinguished as. Quoted in the article, Certified Public Accountant, Certified Fraud Examiner by Leonard W. Bona, CPA, CFE, talks about what errors and fraud actually is. The article talks about the AICPA implementing SAS number 99, which distinguishes that errors are unintentional misstatements or omissions of amounts or disclosures in financial statements, and fraud is intentional misstatements or omissions of amounts or disclosures in financial statements. In this case, this looks and sounds like that it is not an error since it was not unintentional to not mention this account in Hide It Company financial statements. This is an intentional misstatement on the financial statements. There are two types of misstatements that can occur. They are fraudulent financial reporting, which is intentional misstatement in the financial statements to deceive financial statement users, and misappropriation of assets, which is the theft of a company's assets that affects an asset which has not been appropriately reflected in the financial statements. When looking at this incident, the misstatement that has occurred here would be the misappropriation of assets. This is a big enough amount that it would make an impact on the Hide It financials and should have been reported. It could have also been a fraudulent statement, also if the company is using this account to deceive the financial statement users. Either way, there is a misstatement on the financial statements of both types. For this case, though, it seems to be more of a misstatement of assets. There are 3 reasons that fraud is committed in companies. They are 1, incentive or pressure can be a reason to commit fraud. Opportunity to override controls or maybe ineffective controls. Attitude or rationalization about committing fraud by taking justification to oneself. The Hide It Company has not justified the money that is in the account the Arizona Department of Revenue, the IRS, is looking into. The management seems to think that it was done correctly and they did not have anything to do with it since it had been done prior to their management coming aboard. The Hide It Company new management should have been suspicious of this account when they took over the company and became aware of it. There are certain professional standards that outline an auditor's responsibility relating to identifying non-compliance with laws. There is a distinction between laws with a direct effect on financial statements and other laws of non-compliance. There are laws and regulations that are recognized to have a direct effect on the determination of material amounts that disclosures in the financial statements, such as tax and pension laws and regulations. Determination of the amounts and disclosures in the financial statements, but compliance with which may be fraudulent to the operating aspects of the business, to an entity's ability to continue its business or to avoid material penalties. Non-compliance with such laws and regulations may therefore have a material effect on the financial statements. When a non-compliance is identified or suspected, auditors should become aware of information concerning an instance of non-compliance or suspected non-compliance with laws and regulations. The auditor shall obtain an understanding of the nature of the act and the circumstances in which it has occurred, and further information to evaluate the possible effect on the financial statements. Resigning as the auditor would be the best option. It makes an auditor not trust the company fully when they have known about this account since they took over. Also, if they cannot give you the documentation to prove what is really in that account, then how do you truly know they are being upfront and giving you all the correct data for the whole report? With not being able to create and have the information on why this account existed and what the reasoning was for not reporting it on the financial statement as an auditor, if the information is not clarified, it would be in the best interest to resign and not sign off on the audit. That is very important, and the IRS will be researching everything that the auditor has done with this account or why the auditor did not find this account. Will have to be steps to correct this, such as the penalty being paid and the information the IRS received. The company knows it was wrong, and they want to correct an issue that had been done prior to them taking over the company. There should be an internal audit, and controls should be set in place so this cannot occur again.